Hi guys, I'm just going to give you a few seconds to enter the room and we'll get this webinar underway. It's good to see some familiar names here. Fantastic. All right, let's get this underway. So look, welcome. A very good morning, afternoon, or evening from wherever you're joining us in the world. From the FP Markets team, thanks so much for joining us today. Look, we've a reasonably good turnout. So with some regulars here and some newer faces. So look, for those of you who don't know me, hi. Look, I'm so sorry if I mispronounce your name. Is Ione. Hello, Ione. Nice to meet you. So look, my name's Aaron Hill, and I work with FP Markets in their research department. So in my 12 years with the charts, I feel I've really accumulated a sufficient experience to help newer traders build a basic foundation and develop into market technicians, which is what I hope to at least help achieve today. Before I begin the presentation, I hope we can all see the welcome slide and hear me loud and clear. If there are any issues, guys, please do let me know in the chat box and we'll try and get you up and running. So look, otherwise, look, as I say in every webinar, a recording of this presentation will be available through the usual avenues, guys. The easiest way to locate a previous webinar recording is through the FP Markets main website. And you can find that on the main website, on the main menu under resources. Look, guys, alternatively, if you're a big YouTube fan, head over to YouTube and just key in FP Markets and you'll see all the recorded webinars there. So look, quickly, disclaimer, trade responsibly, guys, that should be a given. Derivative products are highly leveraged, carry a high level of risk, and are not suitable for all investors. Features of our products, including fees and charges, are outlined in the relevant legal documents available on our website. So look, guys, really what this is saying is, what I'm saying really is anything I talk about here is really educational advice only. Okay, so look, let's move on really quickly. We have a lot to get through this evening. So as you can see on the slide here, we have a number of topics that I wish to go over during today's session. So introduction to chart patterns. So this is really where I go into the basic details of chart patterns. Flag and pennant formations. I'm pretty sure you've heard of all these. Wedge configurations, head and shoulders pattern. Head and shoulders pattern. I thought I spelled shoulders wrong then. So head and shoulders pattern. So that's the top and the bottom, or the top and inverted pattern. We also have triangles. And look, guys, I know the double top and double bottom pattern, triple top and triple bottom patterns are also popular. So look, if I have time, I will go over those as well. And finally, we have a Q&A session. This is where I'll really open the floor to you guys and let you interact with me and answer any questions you may have regarding tonight's content. Look, if you do have a question during the presentation, please feel free to shoot the question in the chat box, and if it relates to the current slide, I will answer the question. Look, so one thing I will highlight, and I point out, I think it's right, I point this out, everything I show here this evening is what I consider textbook. So meaning the patterns identification standards and measures are taken from well-known authors. So look, I know from experience that traders adapt pattern arrangements to suit their trading methodology. This is fine. I absolutely get this. At least in my experience, trading is a subjective art. So whenever I switch from what I believe to be textbook to my own personal views, I will try my best to remember to underline this as we go. Also, please feel free to share your views on the patterns shown. One other thing I feel that's worth pointing out is that although we keep our own records of pattern success rates, well, I hope you do, a gentleman by the name of Thomas Bukowski has done considerable work on this. So do be sure to check out his content. He runs a website called the Pattern Site, and he also has a book titled A Visual Guide to Chart Patterns. Look, and if memory serves me correct, his work states that a tight bullish flag and a head and shoulders top are some of the best performing patterns. And look, guys, these are not small tests he did. These are tests over 3,000 samples. So these are not, these are really not just samples of 10 or samples of 20. There's 3,000 examples. Look, without further ado, let me just check the chat box. Oh, you're very, very welcome. No, look, I'm so sorry. I'm so terrible with names. So please accept my apologies. Thank you very much for your kind comments, Noel. You are more than welcome. So look, without further ado, let's get this underway. And I really hope it can really open your eyes to some of the chart patterns that do show on the charts. Now, look, I just will say one thing before I get into the details. Trading is not, right, so for instance, if we see a bullish flag form, there is no guarantee that individual pattern, that specific trade sample will be successful. It's over a sample of trades. So for instance, over 100 trades, that's where you'll see the edge start to play out. So individual trades mean very little in the grand scheme of things. A loss here, a loss there, 3 consecutive losses, 4 consecutive losses. Although they hurt, they don't mean anything in the grand scheme of things. As long as you have proof that you have an edge through your back testing, through your forward testing, these are ideal patterns to be looking for on the chart, along with pattern chart structure, so support and resistance and things. Hopefully I will have enough time to go over that with you guys. So look, the terms pattern and formation are often used interchangeably, which is something I'm also guilty of. I also sometimes use the word configuration, as I did in the previous slide, but they all mean the same thing. Right, so what are chart patterns, and are they means of successfully navigating the market on a consistent basis? Bear with me. Depending on who you ask, you know, each answer will be slightly different depending on their experience level within the markets. Now, I'm sure most of us have heard that patterns don't exist on charts. The price is random and has no structure. That's fantastic. That's fine. And for those who believe that, that's, you know, everyone's entitled to their opinion, and I respect that. But for me, I truly do believe that they do exist, and I know of traders that make money through these patterns. So for me, I humbly disagree with saying that they don't. Mustafa, that's a really long message there. I'll get to that in a minute. Okay, just bear with me. So look, in terms of the chart patterns not existing, they don't exist. This is largely the opinion of many academics, as far as I'm aware. So really, again, guys, for me, I have found that patterns do form in the markets, and these, as far as my experience goes, are formed on the back of traders' emotions. This is not only down to my personal experiences, but also traders, as I've said, I'm in contact with, who use pattern structure to generate trading decisions. But ultimately, of course, it is down to you to decide and prove for yourself whether patterns are, shall we say, real or not. What I mean by this is you will need to conduct thorough back testing. And I'm not referring to 10 trade examples. You should ideally target much more than this. Look, remember the Thomas Bukowski, 3,000 samples. How many of us here have conducted a test of 3,000 samples? I'm pretty sure none of us have. I haven't, for sure. So if you have, I really, I'm in awe of you. So that's fantastic if you have. And so look, I guess if you're trading the daily time frame, for me, 20 to 30 trade samples is okay. It's a good start, and this may be sufficient. But look, really, especially on the lower time frames, I would want at least 100 to 50 to 100 examples on each pattern you're interested in. Ideally, forward tested with a demo account or a small live account. But you can also use things like the Forex Tester. I'm sure you've heard of that. And also TradingView, they have their own back testing equipment as well. So look, this is something you should really look into if you're serious about patterns. What I don't want you to do is to go from here and think, oh wow, we have patterns, let's look for them on the charts, mark up a couple, let's sign up, sign up to a live account and start trading them. It's not how it works. You need to have confidence. You need to have the statistics behind you before you enter, before you open a live account. Just don't do what I did when I first started, and it was a big mistake until my mentor guided me the correct way. Thankfully, he did. Otherwise, I would have lost my entire account because I was very confident and I was doing very, very well, and I was very inexperienced. I really did not know what I was doing at that point. So I've also been told on a number of, I'm sorry for talking so much here, but I've also been told regarding this slide, I've also been told on a number of occasions that it is not technical patterns that generally causes failure in this business. It is the trader. Look, chart patterns themselves will offer similar characteristics to the preceding patterns developed, but the outcome will be random. This is exactly what I was saying just a minute ago. Which remains a difficult piece of the puzzle for many traders to understand. However, over a series of trades, there is usually predictability. Guys, if you're really interested in psychology and things like that, do check out the late Mark Douglas. He has plenty of YouTube content. If you're more akin to learning through video, check out his content on YouTube. I'm in no way affiliated with Mark Douglas's work. Also his book, Trading in the Zone, is fantastic. Oh, Thomas, so let me just write that in there for you. Here we go, test my spelling. Bukowski, I think that's how we spell it. So there we go, Alomi. Oh, so sorry if I mispronounced your name. Thomas Bukowski, that's his name there. Just do a quick Google search and you'll find all of his work there, and his fantastic website he's got. It's a pretty outdated website, if I'm truly honest, but the content is second to none. And I've seen no one else conduct thorough research on patterns. I hope you can all see his name there, guys. So again, no affiliation to this gentleman either. Okay, right, so let's move on. Okay, here we go. So, right. So here we have the bullish and bearish flag patterns. Pretty basic structure, I guess. Now I'm sure you guys have seen other traders use flag and pennant patterns in forums and across other media channels, and likely for good reason. These formations here, bullish and bearish flags, are considered high probability patterns and offer frequent opportunity. The name of his book, oh, you know what, I cannot remember. I've just spoke for the last 10 minutes, it's gone. But the name of his website is simply The Pattern Site. Let me just type that in, guys. Pattern, I think this is how it comes across, patternsite.com, and you'll have everything there. You'll have his book on that website as well. And if you just type in Thomas Bukowski, his website will be one of the first results. Right, so bullish and bearish flags. The majority of textbooks I've come across states that these patterns are generally shorter than 3 weeks, right? So in duration. However, myself and other traders do employ these patterns on the screen here on much shorter time periods, and as I'm sure you guys do as well, like the H4, the H1, and even lower time frames, right? So this can form on the good thing is the market is fractal. So a bullish flag can form on the monthly time frame. A bullish flag can also form on the 1 minute time frame. As you can see from the slide, so we have the bullish and bearish flags at the top and the bullish and bearish flags at the bottom. So what is a pole? Here you can see we have with the bullish and bearish flags, we begin with a pole, what's known as a pole. Look, and with the bullish pennant and bearish pennant, we begin with a pole. What a pole is essentially is a strong run, either higher or lower. So it's a decisive run within the market. So a decisive up move, or a decisive down move. So this is important, yet, guys, this is often an overlooked element. Do not regard this point. Do not just go picking out these tiny consolidations here and here. Look for the flag pole. Look for the pole that precedes the pattern. This has to be decisive. I'm not talking that there doesn't necessarily have to be one strong bullish or bearish candle. It can be a number of bullish or bearish candles, but it has to be decisive. It can't be this and this and that and this. You know, it has to be relatively decisive. Quite subjective, I guess, but just look for the most. It doesn't have to be, look, it doesn't have to be vertical. It can be just like this, okay? But it has to be, you know, as I said, decisive. So another point to take on board is that flags and pennants should look proportional to the height of the flag pole. So ask yourself whether the flag is too big for the pole. Now, for me, let's just make this nice and easy. For me, what I look for is a, bear with me, is a, I don't want the low of the flag to cross below. For any of you that do not use Fibonacci, this is pretty basic. So the Fibonacci retracement I set from point A to point B, and I do not want it to cross the 38.2. Imagine this was the 38.2, okay, percent retracement. I do not want it to go below there. Normally, this really keeps it structured, okay? 38.2% of this flag pole. The same goes for the bearish flag and the bullish and bearish pennant. So that's an easier way. It's an objective way to ensure that it's in proportion, your flag. So for the flags, the pattern's makeup is simply formed by two reasonably parallel descending lines for the bullish flag, two reasonably parallel ascending lines for the bearish flag. Quite simple. And it's important to make sure that you have at least, let me get rid of those drawings. Oh, whoops. It's important that you have 1, 2, 3, 4. 4 points of contact, guys. So 2 to the upside, 2 to the downside. Okay, so again, 1, 2, 3, 4. 2 on the upside, 2 on the downside. Pretty simple stuff. So it has to be 2 points of contact at least. Let's get rid of those awful drawings. Okay, so look, for the pennants, we look for 2 converging. This is important, guys, converging, ascending or descending lines. And as you can see on the slide, and what they do is they form a tight triangle formation. Okay, so again, we have the pole. Then following this, we look for the 38.2% retracement, but within that retracement, we look for price to converge within the triangles. It's quite a nice pattern. I really like these. When actually, if you look on Bitcoin right now on the daily time frame, there's a bullish pennant, unless Bitcoin's changed in the time I've got on here. There's a nice bearish pennant forming at the moment. So again, guys, 2 points of contact, 1, 2, 1, 2, and yes, so here we have more, of course, but the more the better. Within this, on what you're looking for is a nice tight formation, even tighter than this. So what you're looking for is a nice direct pole, and then a nice area. Oh, whoops, I didn't mean to do that. Sorry. So what I'm looking for is this, and then a lovely, there we go, and then that. Okay. It's nice and tight, like this bullish and bearish pennant. This is not so great. I'm not known for my artistic abilities, obviously. So look, the bullish and bearish flag. Okay, so we're looking for a nice tight area with little space in between. Okay, so look, number 1, look for the flagpole. Look for it to be decisive. Look for the consolidation of the bullish flag or the bearish or the bullish pennant, bearish flag, bearish pennant, whatever way you're trading, and look for it to be nice and tight, okay, with little space in between, and make sure it doesn't come past the 38.2% measure. Now, importantly, flags and pennants can essentially slope in either direction, yet the most common you will see the pattern structure is to lean against the prior trend. So if the trend is higher, let's get rid of those drawings, guys. So if the trend is higher, higher high, higher low, higher high, it will usually lean against the uptrend, okay? That's the most common. And really, as this is the most common, and this is really all I look for, I don't go for the patterns that form like this. I just don't. It's just me. But you can you can find them and you can trade them. But for me, if you know what, I probably can't even draw it. For me, this would look more like a wedge. Do you know what I mean? So I would probably leave this for me, and I would stick to the basics, especially for newer traders, where they lean against the trend, okay? Now, these patterns are typically considered continuation patterns within a prevailing trend. So also for traders who use volume studies, the volume tends to decrease within the pattern's formation. And, you know, at times you can also see an increase in volume on the breakout to the downside, breakout to the downside, upside. You usually see a right. So Caro, I have seen your question. Just bear with me, and I will get to that very shortly. So as I said, volume is sometimes something you can look at. But look, if you're in the FX market like I am, you don't have access to genuine trade volume unless you're trading the futures market, which is exchange based. So then you have access to trading volume. But in the FX market, especially with brokers, you know, retail brokers, it's tick volume. Okay, you're not trading. You're trading the volume sent through from the interbank market. So the liquidity providers that supply the broker with the data, that's the volume you are getting. Okay, it's the volume that the traders on this broker, on any broker, are using. Okay, so just be aware of that. I won't go into too much detail on the volume or anything like that, because I believe this is something you can look at once the webinar is finished. So one final note in terms of the bullish and bearish flags and pennants is the take profit target. And, you know, look, entry as well. Let me just get rid of those drawings. So on the entry, you can look for a close outside of the pattern, and close outside. This is just a filter, guys. Some people, some traders do trade. Once it just tips below there, they're in. Okay, not for me. I need some sort of filter. So a basic close filter is fine for me. Some even look for a time filter. So you close outside of this area, and they want to see 3 or 4 candles prior to entering. Some want to even see the retest form. Boop, boop. You can see that, right? So let me just get rid of those drawings. You can see this. We break out, we retest this level, and then we shoot higher. And again here, let me just do the bearish one. We break out, retest, boom, and we drop south. So this is something to bear in mind, but it's always on the breakout of the structure. In terms of the profit target, flag target, as you can see here on the drawing, all this is the distance of the flagpole. Okay, from this point here. So imagine this is 100 pips in FX. We remove this value. We simply copy it. This is what I do. I copy and paste this distance, and then simply apply it to the breakout point. And it's from this breakout point that you then extend this, and this would total 100 pips from here to here. So 100 pips and 100 pips. It's the same thing. You're just extending it from the breakout point. Same with the bullish pennant, guys. There's no difference. Flagpole, measure the flagpole, and take this value, and then apply this to the breakout point, and that will give you your objective take profit point. Right, so the other point I really wanted to make with bullish and bearish flags is they can sometimes be called half-mast patterns, or sorry, half-staff or half-mast patterns, and you'll see these in the textbooks. And what they mean is, so within a trend, so imagine the trend is you know, I don't really agree with this, but I thought I would mention it. So half-mast or half-staff patterns, what they're saying is this area here is telling you that we are 50% the way through the uptrend in this point here. So do expect a potential reversal at the profit objective. That's all they mean. Would I pay too much attention to this? No, I wouldn't, to be honest. I just thought I would mention this because you will see this if you do look in the textbooks. Okay, as time is of the essence, one question from Caro. What is the best time frame to look at those patterns? So bullish and bearish flag patterns, I love the H1 time frame. I really like the H1 time frame. H4 time frame, you can also find them on daily time frames. Very, very good if you have the patience. But look, as I say in most webinars, the time frame is really down to you. It's really down to your personal circumstances. If you work full time, the daily time frame may be something you can look at, right? If you can only check the charts once a day, the daily time frame could be ideal. The H4 time frame, even H1 time frame may be a little bit difficult, but if you can check it at work, at your lunch break and things like that, then the H1 could be something you could look at. It all depends on your time frames. There is no really definite answer for that, Caro, I'm afraid. It all depends on your personal circumstances. Okay, wedge patterns. So I guess some of us here going by this slide are wondering, are really wondering what the difference is between wedge patterns and pennant formations. No worries, Caro. I hope that helped. The key difference for me is, unlike a pennant pattern, so the pennant pattern, let me just go back to this. Unlike the pennant pattern here, the wedge configuration or the wedge pattern does not require a sharp move to precede the pattern, unlike the pennant, which it does. Remember, a decisive move to the upside, a decisive move to the downside is required as part of the pattern's rules of engagement. And with the bearish wedge and bullish wedge, it's not a requirement. Another point is the wedge tends to be more of a longer term pattern, whereas a pennant is more shorter term. Remember, the pennant pattern is more like 3 weeks, but 3 weeks in the maximum, 3 weeks in duration. Thomas Bukowski, the gentleman I mentioned at the beginning, actually states on his website that the wedge pattern's duration is a minimum of 3 weeks. Otherwise, he tends to consider them as pennants. He also underlines that the pennant pattern requires 5 points of contact. Now, this is 3 points at the trend line. The pattern trend line is here. So 1, 2, 3 points of contact, and at least two tests on the opposing channel line. So we can have 1, 2. We have more here, but I hope you get what I hope you understand what I'm trying to show. At least three points of contact on the pattern trend line. Just think of it as a normal trend line. The opposing channel line has to have at least 2 to be a valid bearish or bullish wedge. Wedges are also a pattern that can form in the shape of a consolidation. They genuinely can against the prevailing trend, and also as topping and bottoming patterns, i.e. reversal structure. Again, guys, remember we do not require a pole to precede the wedge formation. So, for example, here we have a rising wedge in this box here, the left box, and this is formed within an uptrend. Okay. And the buyers, look, are clearly beginning to lose steam. Let me just get the handy pen out. Actually, let's use the spotlight here. There we go. That's better. So we have a clear uptrend. And, you know, when price starts doing this, starts compressing within two converging lines, forget the names, forget everything else. What is this telling you? Think about it. What is this telling you? We're in an uptrend. Price is strong here, but then starts slowing down there. What is this telling you? What does this tell you is happening in the market? If you want to answer in the chat box, please go ahead. That would be fantastic. But wow, we have someone answering. Fantastic. Oh, we don't. Okay. Could you use the gold as a bullish wedge, please? I haven't got the chart, so I can probably find it. Just give me a second, Diego. I might be able to have time to have a look at that. But check out Bitcoin, guys, on the daily time frame. See if you can see what I'm seeing. Bearish wedge, bearish pennant pattern. Right. So what we're seeing here is upside momentum is diminishing. So for anyone that looks at the RSI, it's a very, very popular momentum gauge. What you may see is this without even having the indicator on. You may see we have divergence in the indicator. So we're forming higher highs here, but the momentum is clearly slowing. So we have bearish divergence on the RSI, but we don't even need the RSI. We can tell already from the chart that momentum is clearly slowing. So once you gain enough experience with the charts and you really train your eye to read the charts, there's only a few people I know that can really read charts very, very well. And they've been doing this for years and years and years. And it's a passion of theirs and a passion of mine as well. So the more you read charts, it's almost like a story. They're telling you a story here, right? Upside momentum is clearly diminishing here. What happens then? Once the buyers run out of steam, generally you'll see price deteriorate. And look, there's nothing here. There's no support. Yeah, we have the lows here. But other than that, the demand is all consumed. It's been consumed. It's buyers have been filled, and then they crunch lower. Okay, so yes, thank you, Noel. Buyers losing control of the market. Yes, look, I was more looking for the second comment and momentum in the market. Momentum is being lost in the market. So you can call this whatever you like. You can call it a bearish compression. As long as you understand what's happening in the market, who cares what the name is? Who cares what the author named it? As long as you can see what's happening, as long as you can understand what it's telling you, you don't need to even understand the names. You just need, as long as you understand what's happening in the market, that's all you need. Okay, so, all right, let me get rid of those circles. Right. So I hope that comes across as pretty clear. Look, right, I'm just checking my notes here. Sorry, guys. Look, there are no measuring techniques in terms of, as far as I know, there are no measuring techniques in terms of to estimate how far price will decline from the bearish wedge. Look, some traders do simply just take this level here, and so from the base of the pattern, and they extend this lower, okay, and then they use that. But for me, look, once you get more advanced, once you extend past the basics of the pattern structure, you can look at price action. You know, momentum was struggling here. What's happening within this area? It's obvious what's happening. Buyers are being filled. Then once price gets here, there will be some buyers here for sure. But once, it's highly unlikely, because what happens is these bearish wedges, they form into strong resistance, okay? What happens when it forms strong resistance and you have very little buying pressure here? You'll get a strong move to the downside, and that's the move you want to be in. So once price breaks out from here, whatever filter you want to use, you get in there and you try and ride this as much as you can, okay? Now, don't fall for when traders talk about, what do they say? The winners will take care of themselves. I really detest that saying. How is that even possible? Within a trade, when you're in a trade and price is doing this, right, okay, we're long and the price is doing this. How's that taking care of itself? You still need good trade management. Your fears, your emotions, your fear of losing your profit, you know, it's all part of learning how to become a trader. To become a trader, your skill set, you have to have a very broad skill set. You have to be emotionally sound. You have to have a structured trading strategy. You have to understand what the markets are telling you. Okay. So I've really gone on way too much with this. I really shouldn't have gone on so much. I'm sorry, guys. Look, in terms of volume, we do tend to see volume. If you're a volume trader, we do tend to see volume decrease within this pattern. Okay, so that's something you can look for. And on the breakouts, we do tend to see breakouts volume increase. Right, so I've got rid of those. Excellent. Okay, next we're on to the head and shoulders. Bear with me, guys. So as you can see, head and shoulders, top reversal, bottom reversal. So the head and shoulders top is, and so this is normally called the head and shoulders top and the inverted head and shoulders, okay? Now, as I said, probably one of the most well-known chart patterns today with the likes of Bukowski, the guy I keep mentioning, stating its statistical significance as one of the better performing patterns. With more than 50% of the time price reaching its target, if memory serves me correct from his website, and with nearly over 3,000 trade samples, the head and shoulders is one of the most well-known and one of the most high probability trade setups. Now, I will say that I would never, ever, ever trade these in isolation. I always look for confluence. Confluence, for anyone that's unaware, is simply where we have a collection of technical tools converge at a certain point. So always look for something to bolster your pattern. So it could be something as simple as you have resistance at this point here and you have a lovely head and shoulders form. All right, the pattern consists of 3 defined peaks or troughs, okay? The troughs are for the inverted pattern and the peaks are for the top reversal. The first peak in the, I'm pretty sure you guys know this, the first peak is called, as you can see, the left shoulder. The subsequent peak is the head. The following peak is the right shoulder. So note that the pullback to form the right shoulder does not break the recently formed head. So what I mean by this is once we form the left, let me get the highlight, right? That was pretty cool. That was. Okay, so once we're at this point and we form the pullback here, generally, we never want to see the right shoulder eclipse this head. Okay, you do not want to see that. So you want to see a nice left shoulder, a head form, and then a right shoulder. Okay, so that's something you really need to take into consideration, because if we break that, the pattern's invalid. Although not often, I say although not often, it is quite often. You can see this on the charts. You have things. Oh, sorry. One thing I should note is the left shoulder and right shoulder. Although not often seen on the charts, I do like to see these form in a relatively symmetrical manner. What I mean by this is the left shoulder forms at, say, 150. I want to see this form around 150. It doesn't have to be to the pip, guys. It can be 150 there, 148 there. It just has to be in the same region. What I don't want to see is the left shoulder here, head there, and the right shoulder up here somewhere. I just don't like it. It's just my personal opinion here, guys. If it works for you, it works for you. That's fantastic. But for me, I try to look for almost perfection in the chart patterns I look for. And another thing, another feature worth underlining is you will often hear experienced traders talk about complex head and shoulders patterns. So all they mean really is it's not really complex, to be honest, but that's what they call it. This is what the authors called it. So or a head and shoulders bottom, a complex head and shoulders bottom. Now, these include patterns with 2 left shoulders. So let me draw this on. Bear with me. So we have 2 shoulders here, and then we come up. We have a head, and then we have just 1 shoulder there. Okay, so we have 2 shoulders here. This can also have 2 heads as well at this point here. Okay, it's just called a complex head and shoulders top pattern. Okay. Let me get rid of that. The neckline. Yeah, just bear with me, Christian. I'm going to get to the neckline. You're ahead of me there. Just bear with me, and I'll get to that. Okay, so when a head and shoulders top is spotted and a neckline is broken, I will talk about that in a moment, and the neckline is broken, it usually signifies the currency pair or any financial market you're trading is headed lower. This brings me nicely on to the neckline. So the neckline for a top is, you're not really going to see it that well here. So let me draw another one. So we have imagine we're in an uptrend there. This is the price. Okay, we form a head here, and then we come down, and then we form this. And then, right, okay, the neckline is at this point here. So it's drawn. Whoops, let me imagine that there. We draw it between the two troughs within the pattern, okay? The two troughs in between the peak of the pattern. So for top formations, it's best to see the neckline either in an ascending formation or a horizontal formation. Now, the reason why, I hope you get this, guys. So we don't want to see, this is perfect. We want to see an ascending neckline, okay? Or just quickly, we have this one. Oh, sorry, guys, that's not what I meant to draw. Oh, God, my drawing's awful. I'm sorry. Just bear with me. So we have the head, shoulders. Okay, and we have that. Okay, what we want is either a horizontal neckline. So the neckline is drawn from the two troughs within the pattern. Okay, so the two troughs here and there, and that's extended along to the right. You can either have it ascending, which is fantastic, or you can have it horizontally. Now, the reason why I always look for ascending or horizontal is purely because of the entry, right? So we want to enter here on the breakout below here, and that stops can be either above the right shoulder or above the head. I would always go for the right shoulder, to be quite honest. I think it's very conservative if you're going for the head, but look, each to their own. If that's what works for you, fantastic. But so we look for a breakout to the downside of the neckline. Okay, so we look for a breakout at these points. This is a breakout, and we enter short here. Put the stop there. And the reason why we look for ascending or horizontal is purely because of the distance between the stop and the entry. If we was working with a descending neckline, let's just draw that on. Whoops, that's not a great one, is it? But look, there we go. We can, it's terrible. I hope you get the drift here, guys, what I'm trying to say, the gist of what I'm trying to say. If we have a descending neckline, our entry will be so far from, our entry will be down here somewhere. We'll be entering here, and our stop will be above there. So risk to reward is very, very difficult. This is why I look for a horizontal or ascending with the top reversal. Now, with the bottom reversal, it's either horizontal, there we go, or to the downside, descending. So ascending with the top, descending with the bottom, or inverted neckline. There was a question on that. So your question, Christian, the neckline should form straight or a horizontal line. I hope I answered that question with my unbelievably great artwork. If not, do let me know and I'll answer it in the, yeah, fantastic, Christian. If not, do let me know and I'll try and redraw something a little bit more presentable. Right, okay, so now moving swiftly on. Bear with me. Okay, triangle patterns, guys. Look, again, let me just see, questions, nope. Oh, fantastic. Right, triangle. A number of pattern structures fall under the umbrella of triangle patterns, including the standard triangle, i.e. the, as you can see here, the symmetrical triangle. We also have ascending and descending triangles. Look, the wedge and pennant formations, which we've already looked at, you know, they're also triangle formations. We also have something called the, let me just draw this for you guys because it's quite a crazy pattern. We also have something called the broadening pattern, which is more like a megaphone. So price is here, comes in, boom, boom, hits the outer limits of. Now, how you would trade this, I have no idea. But you can also, if you have this form, and then you have a symmetrical triangle form, and price continues to compress within this area now, and you get a breakout to the downside, and the preceding price action was in an uptrend, these are absolutely awesome patterns. Now, if you look at Thomas Bukowski's website, this is one of the top performing patterns, but it's very, very rare. So if you can find this, I've seen some analysts try to draw these on the charts. 2 points of contact each side, 2 points of contact each side. Sorry, guys, I should have hit that one there. I hope you get the drift there, guys. 2 points, the gist, not the drift, the gist. 2 points there, 2 points there, 2 points there, 2 points there. So you're forming like, I've just said the name, I've just forgot the name. A diamond top, I think it's called. Diamond top. And you also have the diamond bottoms as well. I think, if my memory serves me correct, the diamond bottom is the more, I'm not even going to try and draw that, but it's exactly the same as this, but forms at the bottom of the market. Anyway, enough of that. Symmetrical triangle. So for the purpose of this presentation, we'll focus on symmetrical triangle, ascending and descending triangles. I'm sure you've all heard of these patterns. So let's kick things off with what's known as a symmetrical triangle. Although you would expect this formation to have symmetrical sides, although it does in this drawing here, it rarely does. And that's why many textbooks also label this pattern as what's known as a, let me try and put this on, a coil, okay? Many authors also label the symmetrical triangle as a coil. And that's because really price essentially coils within the converging trend lines, right? It's almost like a pennant pattern. A pennant pattern. But with the pennant pattern, remember, guys, we need a defined up move. Here, we don't need one. It could just be like this, and when we see price start to converge, converge within its triangle. So, all right. As for volume, so these, as I said, you don't. Just trying to think of what else I was going to add to this. Within the price action must touch the trend lines at least twice. Again, guys, always 2 points of contact. 1, 2, 1, 2, and similar to what you would need with a traditional trend line, shall we say, to activate its presence. I look for at least 60 to 90% of the space to be covered before considering it valid. Look, this goes back to what we were talking about with the bullish and bearish pennant patterns, and I want the space to be filled, right? So I want at least 60 to 90% of the space filled. It doesn't have to be, completely filled. Don't go too far with this. It's just you'll get to know what I mean the more you look at the charts. I want to see a nice tight formation, basically. I think I read from the Edwards and McGee book of technical analysis that most of the breakouts of the coil pattern actually occur around 75% of the pattern. So they'll generally form around these points here. Okay, that's according to those authors. Though it's important to note that false breakouts or premature breakouts are common. So be sure to have some filter, guys, because you will get whipsawed out of your positions if you don't. As for volume does tend to decline during the symmetrical triangle. For the price target, traders often estimate the extent of the move after the breakout by simply measuring the widest distance of the symmetrical triangle from these points here. This is called your base there, and then simply extending this value here. Okay, that's great. So let's move on. So look, most symmetrical triangles should be longer than 3 weeks to help distinguish them from pennants. It's not always necessary, though, of course. As long as we don't have a strong up move prior to this, this is more than likely going to be a coil. But look, guys, I know we will be looking at these patterns on the lower time frames, and that will not reach the 3 week characteristic. But therefore, attention should be paid to the flagpole, in my humble opinion. So if a triangle lacks a pole, it's likely a wedge formation or a symmetrical triangle. Okay, ascending and descending triangles. As you can see, ascending triangles are wedge-shaped patterns that break out most often to the upside. What you have is a horizontal resistance to the upside, which consistently rejects price, but at the same time, sellers are losing strength, sellers are losing strength, losing strength, losing strength, losing strength, and then bang, we blow to the upside. And you can see buyers are gaining strength from this ascending line. So it's almost like it coils with enough pressure, and all of a sudden, the volume really explodes to the upside. And these are generally considered continuation patterns, the ascending triangle and descending triangle, but they do also occur as reversal structures. So do be aware of that. Do not, I would always wait for a close filter, at the very least, of these patterns. So a close above or a close below. So what this is telling you, look, read the patterns. What it's telling you, buyers are gaining strength, sellers are not. But if this forms out a resistance, a strong resistance here, this could be time to, you'll see a breakout to the downside, and boy, would that be strong. These are very, very high probability reversal structures, as far as my memory serves me. Again, according to the textbooks, volume does tend to decrease when the pattern forms. But on the breakout, you can see an increase in the volume. Look, in terms of entry and stop loss placement, entry is usually placed on the breakout of the pattern and the stop just above. So the risk to reward, if price continues lower, look again, guys, if we do break out to the downside, most of the buyers are filled here. Most of the buy orders are filled. We've compressed higher. Okay. It's only if we break out to the upside, we have a truckload of breakout buyers coming in. But if we break out to the downside with force, we could be in for a strong move to the downside with only a very tight stops above here, entry there on the breakout of using a closed filter. But look, if there's a resistance here, guys, do place your stop above the resistance. Don't try to be greedy and just place it just above there and your entry's there, because at times you'll see price can whipsaw above there and just come down. Okay, and you'll be left on the sidelines watching what could have happened. So always look at the context of the chart. As for price targets, I believe all we do is we calculate the base distance, which is here. Calculate the base distance from the top of the pattern, the widest part of the pattern, and extend this from this point. Again, though, guys, do check out the structure of the chart. Don't just rely on the pattern's rules of engagement. Let's become market technicians where we understand what's going on in the market. Okay, Mishek, how do you take into account some of the random fluctuations within the pattern as they may trigger your stop loss? Well, they won't. If you if we go back, if I read your question correctly, how do you take into account some of the random fluctuations within a pattern as they may? If you mean whipsaws, but if I've read your question correctly, at this point, you won't be trading, okay? You won't be trading within here. You shouldn't be anyway. You should be waiting for the breakout in either direction before you initiate a trade. So you won't be whipsawed. Your stop loss won't be triggered. But as I just said, if you enter on a breakout here, I would avoid trying to place your stop so close. I know it's tempting, but look, if there's strong resistance around this, a strong support around this area, place it below the support. At least you've got another barrier, another line of defense before your stop loss is hit. And that may avoid hitting, because what you can see is price comes out, whipsaws lower, bounces higher. All right, so I hope that answers your question, Mishek. Okay, any other questions, guys? I know I've thrown a lot of quite a lot at you this. Oh, fantastic. Good. So, okay, great. So look, upcoming webinars, guys, please do consider joining. We have the MACD, and that's on the 12th of July. Same time, guys, MACD, how to interpret a MACD and apply it to the charts. We also have an awesome way of determining support and resistance called the Quasimodo formation. This is on the 19th, and then we focus again on the Quasimodo formation on the 26th. Again, same time, guys. Certainly do try to make this. Let me just check. Do you have a webinar for FA? Are you talking about fundamental analysis there, Christian? I did do a webinar on fundamental analysis. I believe it's in, if you're talking about, yes. Okay, so there is a webinar on fundamental analysis. Just go and search the archive webinars and you'll find it there. Right, so look, guys, thank you so much for taking the time out of your session. I know I threw a lot at you, but I hope it's opened your eyes to think outside the box a little bit with, sorry, with these patterns, and to understand that the overall market structure. Look, guys, please do consider signing up for our Telegram channel. I'm always active on that channel, and yeah, it'll be great to have you along joining. So let me just check any other questions. I haven't seen the website. Thomas in the chat. Okay, bear with me. No, I'll copy and paste that. Just bear with me. So just what I would do, guys, is if you're interested in patternsite.com, there we go. That should be on your screen now. Oops, no, it's not. There we go. Patternsite.com. Okay, go to that. Thomas Bukowski, awesome guy, awesome content, and it really shows you rules of engagement, and much of what I've shown tonight is based on his work and from obviously the CMT program. No worries, Noel, no worries. I hope that's that helps. So look, guys, once again, thank you very much for taking the time out of your evening, day, morning. Have a great session, and I'll catch you at I'll catch you next week, guys. So yes, take care, and I'll see you later. Thank you very much. You're very welcome, Noel. Thank you.